Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, let's just look at the tape. Because the numbers coming out of the close on January 20th, 2026, they tell a story that goes far beyond a simple earnings beat or, a sector rotation. United Microelectronics Corporation, UMC, it surged 15.9% in a single session. We saw a close at $10.78, and it hit a new 52-week high of $11.13 shortly after. And let's be absolutely clear about the participation here. This wasn't retail investors chasing headlines. The volume was significantly higher than the 30-day average. The market has violently repriced this asset. So the question is, are we looking at a fundamental structural re-rating, a genuine peace dividend, or are we staring at a technical trap?
See, I'm looking at the exact same numbers, but I am reading a completely different story on that chart. That 15.9% move isn't a victory lap, it's a classic gap-and-go structure. We opened at 1060, leaving a massive liquidity void all the way down to the previous close of 930. To me, this looks like a dangerous technical extension driven by, sympathy flows from TSMC and a very fragile reliance on volatile prediction markets. You call it a re-rating, I call it a short squeeze running into a gamma feedback loop that is destined to fill that gap.
I think you're missing the forest for the trees here. You're fixating on the mechanics of the jump the gap, the speed of the move, but you're ignoring why the jump happened. This gap isn't a void, it's a line in the sand. For the better part of a decade, UMC has traded under what we all call the Taiwan discount. It has been shackled by a geopolitical risk premium, essentially the fear of conflict, that compressed its valuation no matter how well they ran their factories. What we are seeing now is the removal of that shackle. The market is waking up. They aren't just sitting in Shinshu, they're in Arizona with Intel, they're commanding pricing power over suppliers, and they are trading at a valuation that makes absolutely no sense compared to their peers. I'm arguing this is the start of a structural re-rating where the baseline just moves higher permanently.
And I'm arguing that structure is built on sand. You're talking about a pivot. I'm talking about overextension. As of the close, the stock is trading 35% above its 50-day moving average and 45% above its 200-day. In any normal market, that just screams mean reversion. Prices eventually snap back to their average like a rubber band stretched too far. And look at the volatility profile. UMC has historically been a defensive play, a low beta stock you hold for the dividend. Suddenly, the beta has risen to 1.08. This is no longer a defensive hold. It's become a vehicle for speculative capital. When a utility-like stock starts trading like a meme stock, you have to worry about who is left to buy at these levels.
I'm not convinced because you're looking at the beta as a bug when I see it as a feature of this re-rating. The volatility is rising because the market is finally stripping out the catastrophic tail risk, and this brings us to the core of my thesis, which I know you're skeptical of, the polymarket correlation. If you look at the invasion probability contracts on Polymarket for a cross-strait conflict by 2026, the odds just collapsed from nearly 30% in late 2025 down to about 13 to 14% here in January.
Okay, I have to stop you there. Relying on a blockchain-based prediction market, which is essentially gambling contracts, to justify a multi-billion-dollar valuation swing is incredibly risky. You can't build a fundamental investment case on the betting habits of crypto traders. That is not due diligence. That's chasing sentiment.
Well, hear me out, because this is where the market mechanics get interesting. It's not just betting. It's a real-time quantification of sentiment that drives institutional risk committees. Think about it like insurance actuarial tables. When that probability was at 30%, investors were pricing in a total loss event, asset seizure, destruction of fabs, that effectively spiked the cost of equity, or K, through the roof.
All right, break that down. Why does the cost of equity matter so much here?
Sure. So the cost of equity is basically the return investors demand to compensate for the risk they're taking. When the risk is total loss of my factory due to war, you demand a massive return, which, depresses the stock price. It's the denominator in every valuation model. As those odds drop from 30% to 13%, that risk premium compresses. Mathematically, that lowers the denominator in your DCF model, which immediately increases the present value of future cash flows. Institutional risk committees are looking at that 13% number and giving the green light to re-enter the asset because the disaster tax has been cut in half. The peace dividend is a literal expansion of the PE multiple because that existential threat has receded.
That's a compelling academic argument, and the math works on paper, but just consider the fragility of that signal in the real world. A 13% chance of a major conflict is still a massive tail risk. We aren't talking about a coin flip on an earnings miss here. We are talking about geopolitical stability. If a single headline breaks, one naval drill, one aggressive statement, and those polymarket odds tick back above 20%, your entire investment thesis invalidates immediately. The correlation works both ways. You're arguing the market is pricing in growth. I argue the market is simply pricing in survival. A rally based on we probably won't get invaded this year is not the same as a rally based on earnings growth. It's the definition of a relief rally, and those fade fast.
It's not just relief, though. It's arbitrage. Let's look at the peers, because valuations don't exist in a vacuum. You have Global Foundries, GFS, trading at a forward price-to-earnings ratio of, what, roughly 31. So investors are paying $31 for every dollar of earnings. GFS has struggled with profitability and pays zero dividend, zero. Then you have UMC, consistently profitable, trading at a forward PE of around 13 with a dividend yield over 4%. Why does Global Foundries command that premium? It was the geopolitical premium, the fact that their fabs are in the US, Germany, Singapore, safely away from the Taiwan Strait.
And that premium is entirely justified. Security of supply is the single most important metric for chip buyers right now. Apple, Qualcomm, Broadcom, they will pay more just to know their chips will actually arrive. That premium exists because GFS offers a sleep-at-the-night assurance that UMC traditionally hasn't.
But that moat is eroding. That's the entire point of the Intel partnership. UMC is now manufacturing 12-nanometer chips in Arizona using Intel's fabs 12, 22, and 32. They've effectively hedged their geographic exposure without spending a dime on concrete. This is the asset-light strategy in action. Why would an investor hold GFS at 31 times earnings with no yield when they can hold UMC at 13 times, get a 4.24% yield just to wait, and now have exposure to that same U.S. manufacturing footprint? The valuation gap between GFS and UMC is just unsustainable. Either GFS crashes or UMC moves up. I'm betting on the latter.
That's an interesting comparison, though. I would frame it differently. You're comparing UMC to Global Foundries, but the market is buying UMC right now because of TSMC. Let's be honest about the TSMC effect. TSMC posted a blowout earnings report driven by insatiable AI demand, 3 nanometer, 5 nanometers, CoWoS packaging. That is where the growth is. UMC doesn't make those chips. They are capped at 14 nanometers. They are relying on capacity spillover, basically waiting for TSMC to be so full that customers are forced to send orders for power management chips and display drivers down to the minor leagues.
Calling it minor league is it's a gross oversimplification. It's specialty technology. You don't need a Ferrari engine to run the power windows.
It's a cash cow, sure, but it's not a growth engine. The rally we saw on January 20th was sympathy flows. Investors saw TSMC rip higher, felt they missed the boat, and looked for the next cheapest ticker in the semiconductor ETF. That's why the correlation is dangerous. If the AI mania cools even slightly, UMC will drop faster than TSMC because it doesn't have the fundamental AI exposure to support that valuation. You're buying a lagging edge foundry at a 52-week high during a hype cycle for leading edge chips.
I think you're underestimating the strategic depth of the Intel deal. It's not just about spillover. This partnership involves a significant technology transfer. Reports indicate Intel is licensing its proprietary SuperMIM metal insulator metal capacitor tech to UMC. Now, for those listening who aren't electrical engineers, SuperMIM allows for much higher density capacitors. This is crucial for RF and Wi-Fi 7 chips. It improves power efficiency, signal integrity. It allows UMC to boost their competitiveness without needing to move to the ultra-expensive 7-nanometer process. They are upgrading their capabilities within the 12-nanometer node. And they are doing this while avoiding the ruinous $10 to $15 billion capex to build new fabs.
Okay, the capital efficiency is noted, and I'll grant you the Supermind tech is a nice upgrade. But let's look at the other side of the ledger. Their margin defense relies on aggressively squeezing their supply chain. They mandated a 15% price cut for suppliers like Global Wafers, effective January 1st. While that defends the 30% gross margin target in the short term, it strains relationships. Global Wafers is the third largest wafer maker globally. You can only squeeze your partner so hard before it bites back, especially if the memory market tightens and wafer supply gets constrained again. When the cycle turns, suppliers remember who squeezed them.
But right now, UMC holds the leverage. The memory market softness gives them the room to demand those cuts. It's just smart management. They are locking in lower structural costs for the next 12 to 24 months. That is going to accrete directly to the bottom line in the Q1 and Q2 earnings. It's simple economics. If your input costs drop by 15% and your pricing remains stable, which it is, your margins expand. That justifies a higher stock price.
I worry about the revenue quality, though. Look at the customer concentration. It's MediaTek and Realtek. These are giants, yes, but they are heavily exposed to consumer electronics, PCs, smartphones, TVs. We aren't talking about NVIDIA or AMD data center chips here. If the consumer recovery is softer than expected, UMC takes the hit.
But Qualcomm is there too, using them for RF front-end modules. They are diversified enough in the high-volume segments that matter. Just because it isn't an AI GPU doesn't mean it isn't profitable. Every AI server needs thousands of dollars worth of power management and connectivity chips. That's UMC's bread and butter. You can't run a data center on logic chips alone.
Okay, let's switch gears and talk about the plumbing, because this is where I think the technical trap argument really holds weight. When you look under the hood of that January 20th breakout, it wasn't just fundamental buying. The short interest data is telling. We have a days to cover ratio of approximately 6.5 days.
And for the listeners, explain why that number scares you. Usually low short interest is a good thing, right?
Generally, yes, but days to cover measures how many days of average trading volume it would take for all the short sellers to buy back their shares. Anything above 5 is considered high because it implies illiquidity. So even if the total short interest is only, say, 1.79 to 2.1% of the float, a ratio of 6.5 means that when the stock started to move, the exit door was very narrow. Short sellers couldn't exit gracefully. They were forced to cover, buying indiscriminately, which fueled that 15% vertical move. That is artificial buying pressure. It's not people buying because they love the stock. It's people buying because they are terrified of losing more money. That kind of buying dries up instantly.
That's an interesting point, but I would frame it differently. A short squeeze can ignite a rally, but it doesn't sustain it on high volume unless there's real demand behind it. And we know there is. Look at the dark pool analysis.
Dark pools? You mean the off-exchange trading?
Exactly. Private exchanges where institutions trade anonymously. We saw significant block trades, tickets over 100,000 shares, executed before the public breakout. That is smart money accumulation. That is institutional positioning. They bought in the dark before the retail crowd even saw the gap up. This suggests that the smart money was positioning for the TSMC sympathy play and the geopolitical thaw well in advance. They aren't covering shorts, they are building long positions. When you see accumulation in the dark pools, followed by a breakout, it's usually a sign of sustained momentum, not a flash in the pan.
Or they were setting the trap. You also have to look at the options market. On January 15th, we saw a massive surge in call option buying, a 290% increase in volume. This created a classic gamma feedback loop.
Can we break that down? Gamma feedback loop sounds like sci-fi, but it has real consequences for price.
It's actually pretty mechanical. When speculators buy call options heavily, the market makers selling those options have to hedge their risk. They are short the option, so they have to be long the stock to remain neutral. As the stock price rises, their risk models, specifically the gamma factor, force them to buy more stock to stay hedged. It's like throwing gasoline on a fire. It accelerates the move upward. But here's the trap. It works in reverse. Once that gamma rolls off, or if the stock stalls, that hedging support evaporates instantly. The market makers sell to unhedge, and the stock collapses. You are left with a stock trading at 1078 when the fundamental support might be back at 950.
I'm not convinced. Because the institutional ownership provides a floor. We are seeing passive flows from BlackRock and Vanguard driven by sector-wide ETF inflows. As long as the semi-narrative holds, those flows are sticky.
And maybe more importantly, look at the insiders. We are at a 52-week high, yet there is a distinct absence of insider selling. Management is not trimming positions. If they believe this was a technical trap or a temporary squeeze, they would be cashing out. They aren't. That implies they see further upside, potentially ahead of the January 28th earnings.
Or they are locked out due to the quiet period before earnings, which makes their inaction a non-signal. They legally can't sell right now. But let's step back to the chart. You have a stock that is extended 35% above its 50-day moving average. In the history of UMC, whenever we have seen a deviation this wide, it has almost always been followed by a correction. And the gap between 930 and 1060 is just staring us in the face. Markets hate vacuums. I believe price will revisit that level to test for liquidity before any sustainable move higher can happen. If you buy here, you are standing on a cliff edge.
I see why you think that. But in a breakout scenario driven by a structural shift, like the peace dividend, gaps often act as runaway gaps. They signify a change in the state of the asset. They don't always fill immediately. If we break the 1120 resistance level, there is very little friction preventing a move toward the $13 to $14 range. That is where the valuation would start to align with global foundries. You're waiting for a fill that might not happen until the stock is $5 higher.
But that entire thesis rests on the polymarket odds staying low. You are essentially leveraging a stock portfolio on a geopolitical prediction market. If China conducts one drill or a diplomat says one wrong thing and those odds spike, UMC's beta of 1.08 is going to work against you violently. It is a fair weather trade. You are picking up pennies in front of a steamroller.
All equity investing is about weighing probabilities. There are no sure things. But right now, let's look at the hand we're dealt. You have a company paying you 4.24% to wait. You have a PE of 13 in a sector where 30 is the norm. You have a capital-light expansion into the U.S. via Intel that solves their biggest problem. And you have the geopolitical risk premium, the single biggest weight on the stock, evaporating before our eyes. UMC has evolved from a value trap into a legitimate value play.
And I maintain that when everyone rushes to one side of the boat based on a peace narrative and a sympathy rally, it's time to be careful. The technicals are overheated, the liquidity gap is dangerously wide below us, and the reliance on prediction markets introduces a layer of volatility most investors aren't accounting for. I see a classic bull trap.
Well, we are going to find out very soon the earnings on January 28th, and the Q1 guidance will be the final arbiter. If they confirm the margin expansion and the Intel progress, the technicals won't matter.
Indeed. Investors should be watching those polymarket odds just as closely as the ticker.
That's all the time we have. Thanks for listening to the debate.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.